Yesterday was not a normal trading day. It was not volatility. It was not a healthy correction. What happened was a coordinated psychological operation designed to extract wealth from ordinary investors and transfer it into institutional hands. If you were watching the markets, you saw silver collapse violently, nearly 8% in a single session. Headlines immediately screamed that the silver bull market was over, and analysts rushed to explain why silver had failed again. Fear spread fast, and panic became contagious. If you are honest, you felt it too. The tightening in your chest, the urge to hit the sell button just to make the pain stop. That reaction was not accidental, it was engineered. Because today, Tuesday, December 30th, the truth is already visible. Silver is trading at $74.54, up $3.35 in a single session. Nearly half of yesterday's losses vanished in the blink of an eye. That kind of recovery does not happen after a real breakdown. It only happens after a trap has been sprung. This was never a market correction, it was a bear trap. It was a calculated algorithmic flush, designed to shake weak hands out before the year ends. Banks knew retail investors were leveraged and stop losses were clustered near $72. They pushed price down, triggered those stops, and immediately reversed the market. To understand how violent this move was, you must understand psychology. Markets do not move on logic. They move on emotion. Fear is the most profitable tool in finance. When silver dropped toward $71, weak hands panicked. Tourists, over-leveraged traders, and short-term speculators sold at the worst possible moment. That panic created liquidity for institutions. Large players cannot buy unless someone sells to them. At $80, nobody was selling and strong hands were holding tight, so the market had to be forced lower. This is called shaking the tree. Shake it hard enough and weak fruit falls. Yesterday was the shake. Today is the harvest. Institutions are now scooping up cheap contracts left behind by fear. And here is the key point. Nothing fundamental changed. Demand did not disappear overnight. Samsung is still making batteries and solar demand is still rising. No massive silver discovery was made, and the dollar did not suddenly become sound money. Only sentiment changed. Once emotional selling ended, price snapped back toward fair value. The market is clearly signaling that value is well above $74. This recovery was not random. It was driven by an algorithmic flip. Modern markets are controlled by CTAs that chase momentum. When silver broke below $75, they flipped to sell. Billions in futures were dumped, accelerating the crash. But algorithms must reverse when momentum shifts. As silver reclaimed 73 and 74, they were forced to buy. This created a double buying effect. Short covering plus new longs drove a vertical green candle. The machines were chasing their own mistake. At the same time, gold stabilized. Yesterday, gold dropped nearly $150 due to a liquidity event. Today, it rebounded strongly. Gold trading near 43.70 confirms stress has passed. Quiet liquidity likely entered the system overnight. The Federal Reserve cannot allow deflation. When gold stabilizes, silver runs. Silver is gold with leverage. Gold up 1% means silver up 5%. That is exactly what happened today. Bull market dynamics remain intact. If you endure the crashes, you earn the surge. Now look at the physical market. While paper silver collapsed, premiums did not fall. In many cases, dealers raised them. That tells you everything. Physical silver does not exist at cheap prices. $74 is the minimum needed to bring metal out. During the dip, industrial buyers stepped in aggressively. Smart money absorbed selling between 72 and 73. A concrete floor was built. Paper sellers ran out of ammunition. Physical buyers stood like a wall. Eventually, price had nowhere to go but up. Technically, today printed a green engulfing candle. It erased Monday's shooting star pattern. Bears tried to break the trend and failed. In technical analysis, failed breakdowns are bullish. They trap shorts and reverse momentum violently. This sets up the next leg higher. Now we enter the most important day of the year, the final trading session on December 31st. This is when funds mark the close. They want charts to look good. They want portfolios painted green. That process requires buying. This is window dressing at its finest. Careers and bonuses depend on the closing price. Funds holding silver want it higher. Tomorrow is the Super Bowl of manipulation. Big money will fight to push silver up. This rally is not finished. If silver closes above 75, it validates the breakout. Bears will be trapped. Global confidence will rise. Even though price briefly dipped below the 20-day moving average, it reclaimed it instantly. Speed matters in trading. Quick recovery means trap. Short sellers are now underwater. They must cover into thin year-end liquidity that creates forced buying. Gold's strength also signals the Fed put is back. Markets believe the central bank will step in. Investors front-run that by buying metals. As long as gold holds above 4,300, silver remains protected. Yesterday's crash actually helped the market. It released pressure without breaking trend. RSI cooled off and sentiment reset. We are now in a Goldilocks zone. Perfect conditions for another run. If you feel exhausted, that is intentional. Markets are designed to drain emotion. Stress is the price of asymmetric gains. You are being paid for emotional durability. Weak hands sold yesterday. Strong hands are positioning now. Supply is also tightening. Refineries are conducting year-end audits. Metal flow is slowing. At the same time, hedging demand is rising. There is no slack left in the system. One large buyer could gap price higher. Looking toward 2026, silver is chaos insurance. It protects against elections, wars, and currency failure. Fear demand is joining industrial demand. This is a double-barreled trade. Short sellers are standing in front of it. On the monthly chart, silver has broken a multi-year base. Historically, this leads to 6 to 9 months of upside. We are not late, we are early. January sets up a slingshot pattern. Breakout, pullback, then launch. The mathematical target is $85. This time the move will be healthier. Institutional accumulation replaces leverage. New corporate budgets open on January 1st. Destocking becomes restocking. Samsung and Tesla increase demand. This is demand pull inflation. Banks remain net short and uncomfortable. One bank flipping long could end suppression. Retail is already buying dips. That behavior defines secular bull markets. Internationally, silver is at all-time highs in multiple currencies. Global pressure is building. Volatility will continue. Air pockets will appear. But the trend is clear. Industrial demand is rising and supply is flat. Deficits persist. True price discovery approaches. When price discovery begins, prices do not rise slowly. They jump violently. Your job is simple. Do not be shaken. December 29th was a rehearsal. The real squeeze will be far more aggressive. If silver reaches $100, expect chaos. $10 drops, halts, and panic. Focus on ounces, not dollars. The metal is real. The currency is not. Once 85 breaks, 100 becomes inevitable. When 100 arrives, the world wakes up. Intervention risks rise. Taxes and controls follow. Privacy and physical metal will matter more than ever. The fake crash was a gift. It cleared leverage and proved the floor. The trend is stronger now. Momentum is accelerating. The dollar is weakening. Debt is exploding. Silver is disappearing. You survived the trap. Now prepare for the payoff in 2026.